Bryce, Ren, how are we, boys?
We are well, Brad.
Yeah, good, Brad. Thanks for having us on.
Hey, it's a pleasure. We have the joys of a virtual recording today, and I know you boys are probably thinking we invited him up to the studio. He should have come, but I couldn't get to Sydney today, so we're making the most of virtual. But I'm so excited to have you boys here for a few reasons, because you've built an incredible podcast. The Equity Mates brand is strong here in Australia, and I'm sure in other parts of the world too, because some of your guests, like Scott Galloway, who is a big name and someone I listened to and consumed a lot of his content over in the US. They've been on the platform, they've been on the show, and it's exciting to see what you guys are building as two young Aussies, which for me makes me proud because I'm in that similar boat trying to build, I guess, a media platform as well and a podcast. But I'm also excited to have you here because I need the 101, the investing for dummies, because I am certainly not financially intelligent. I'm probably a bit of a spender, just on the daily things. You know, the coffees, the Gurner would be absolutely burning inside if he's seen the amount of money I'm spending on coffees and avocado toast. So it's good to have you boys here to pick your brain.
Yeah, I mean, it's good to be here. And I think we should be clear, like Bryce and I, we started Equity Mates because we were exactly like you. Like, we didn't really know much about investing. And I think it's a shame that so many Aussies never learn it in school. If our parents didn't teach us, then we just never learn it. So we're testament to the fact that if we can figure it out, anyone can. So come on the journey with us.
Well, it's funny you say this, right? And I think as Australians, we definitely know a little bit less about investing and our financial future than our friends in the US do. It seems to be a topic of conversation for a lot of young people in the US. They're talking about, what stocks or portfolios they're buying. My theory is, and I'm potentially part of the problem because I work as a real estate agent here in Australia as well. So that's the job I'm less liked in, believe it or not. But I think because in Australia we focus so much on property as our primary source of investment as Australians, maybe we focus less on the other things. We have less education around stocks and shares and all of these things.
I also think that there's a difference between how Americans celebrate success and Australians celebrate success, in that Australians have a very, the tall poppy syndrome, cut down those that are successful, and that flows on to people wanting to talk about how successful they've been in their own money journey and investing and whatnot. But you go to the States and there's a real celebration around entrepreneurial, whatever the word is, entrepreneurism. And as you said, chatting stocks. I've just had a winner. Like, there's that celebration of success and wanting to become better and aspiration and ambition. And I think that has flow-on effects to how we talk about our own personal money here in Australia, because you almost don't want to put yourself out there as being successful, and that puts us in this position. But I also can't argue with your comment around property. We're way too obsessed with it. Too obsessed.
And you can understand why. Like, it's been a wealth creator unparalleled for our parents' generation and the generation before that. But prices are out of control. It's so hard to access, and things don't go up and to the right forever. And we see that in plenty of examples around the world at different stages. And I think that the beauty of the stock market is it's so much more accessible. You can just start with really small amounts of money. And like your observation is right. I think the numbers, I was just looking them up. According to the ASX, 51% of Australians invest in the stock market. And depending on the survey over in the States, it's in the high 60s or in the 70s percent of American adults are investing in the stock market. So I think culturally it's just much more ingrained over there, which is a shame because it's been a great wealth creator for generations, and we should be all investing what we can.
I like a stats guy. I like that, Ren. I'm glad you pulled that up. And I must say, those stats actually shock me. So for you to say that 51% of Aussies invest in the ASX, I think furthermore to Bryce's point, it probably shocks me because we don't talk about it. And we certainly have that, I agree, that tall poppy culture. But I have a theory around this called the tall poppy paradox, because a country that was built on mate shit, where we also like to absolutely rip the shit out of each other and tear each other down, is such a paradox. And I think we have to change that. And that's why I celebrate what you boys are doing with your show, because I am at the coal front of this every week as an agent. I'm seeing young couples trying to get into the market. I'm seeing familiar faces that, I had a 4-year break from real estate, but I'm seeing faces that I seen before I left the industry all those years ago, still out looking to make their entrance into the market. And, albeit there are plenty of reasons why some of those people haven't, be it financially, be it maybe a little bit of perfectionism, or maybe a bit of stubbornness that could have got them into the market 6 years ago, before prices have gotten to the point in which it is. But I feel every day this lump in my throat, because part of my job is to get the best price for the people who are employing us to do business for them. But as a young person, when I see those prices, I go, oh my God, I can't believe that's what it takes to get into the market in the area that I grew up in.
Yeah.
And so I think one of the questions I really wanted to ask you boys is, our generation will be seeing things differently. I'm certain of that from what our parents would have, and our grandparents. But our parents spoke about the Australian dream, and I grew up as part of a product of the Australian dream, quarter acre block, brick home, and that was what was advertised as the Australian dream for so long. But I believe that has to change for Aussies. So what do you see as part of the changing and new Australian dream?
I think it can go two ways, and this is something that I worry a lot about. Is we can either I think the Australian dream isn't going to fundamentally change, because what it is at its core is like economic security for you and your family, and that's represented in the owning the house with the white picket fence and all of that stuff. But really, what we all want is to achieve that economic security, and I think at this point in time, if you speak to young people, it's pretty clear that that dream has never felt further away. And really, we have two choices. We can either let a generation of Australians become disaffected and dissatisfied and feel hopeless with their economic situation, or we can make meaningful structural reforms to make that dream a reality again for young people. And I worry that the more we go down that first path of just this feeling of hopelessness, you get some pretty bad outcomes. You get a cohort of people just trying to punt their way to success, thinking that the tried and true methods of slowly building wealth aren't there for you. So it's like crypto or bust, or, whatever it is. Or it's just like none of it is worth it because I'm not going to get there. And then people don't try and make the decisions that they should when they're young to set themselves up financially. I was listening to another podcast recently, and there's a term over in the US that they've coined the Coachella effect. And essentially,
on our podcast.
It was on Your Own Good Company.
Oh, but we spoke about it.
Yeah. I'm rehashing something that I've already spoken about. But it's called the Coachella effect. And essentially, as cost of living has gone up and young people have in the US have got more hopeless and more dissatisfied with their economic situation, what's actually happened is consumer spending has gone up, and in particular, spending on big ticket items like business class tickets and to Coachella and VIP tickets to Coachella, because people don't feel like there's, hope long term. And so they're just saying, I'm just going to spend now. And like, that's a sign that things aren't great. And I think if we don't make changes now and build hope and show people that there is a path to like long-term economic security and that the Australian dream isn't out of reach, it's not going to be great for our generation and the next generation.
Yeah, I think it's a really fair point. And part of my thought process is I'm a pretty balanced guy, lads. And for me, that can mean I'm going to go rip in and train hard. but I'm going to go eat an almond quasi after and knock down a couple of coffees. And I'm also a pretty balanced guy in the sense that I want to create economic stability, as you said, for my future. My partner and I want to have kids. We want a family more than anything. And so I want to be able to do that as a dad and as a partner and provide that for our future. But at the same point in time, I want to live my life. And maybe generations of past eye roll at that and go, oh, this fella wants to be in Europe soaking up the sun. Well, it doesn't work that way, bud. But I would like to think I'm an optimist. But I want to be an optimist, but also a realist. And so coming to grips with how that looks for our generation, I think is a really important conversation. A generation that wants to be able to live their life and have experiences, but also set themselves up so that we aren't faced with the challenge of, being 65, 70, whatever retirement age is. It'll likely be 75 by the time we get there, and thinking, well, we either have to live in the caravan or continue to work. And I think that's a real challenge for this generation if we don't set ourselves up for the future.
I think it just comes down to the education piece, though, because if you think about how mortgages are structured and the willingness for people to take out huge amounts of debt and then commit to a regular payment every fortnight or every month for 30 years, like that financial habit can be transferred to the stock market incredibly easily and from day one without the need for a $100,000 deposit, stamp duty, legal fees, 6 years of stress trying to find the right house. Like, everyone thinks that they can't do it or they don't have the means to do it, but they can do it, and the willingness to do it when it comes to a mortgage is there. So I think for us, that's one of our big frustrations, is how people are willing to go out and take 700,000 in debt without blinking an eye and sacrificing almost everything in their life to do it, but then thinking that the stock market is not for them, too risky, and it's not going to get them the same result at the end. In fact, it might even get you a better result, you could argue. So yeah, it's an education piece.
Here are the numbers that we always like to trot out. So the Australian stock market between 1900 and 2022, so that's 122 years, the annual average return in that time, 13.2%, including dividends. Now, if you took $100 a week and invested it in the Australian stock market for 30 years and got that 13.2% return, that's just shy of $2 million. So like that's not picking crazy stocks. That's not doing, heaps of research and monitoring your stocks every day, looking at the charts, all of that. That's just buying like an overall index of a little bit of all the Australian companies. And we can get into what that means in this conversation. But I think, to Bryce's point, that regular, disciplined mortgage repayment mindset, if we apply that to the stock market, the ability to build wealth and build economic security is still there.
Well, you hit the ball over the fence. I'm going to hit it back. You spoke about, buying into those index funds. This is where, for me, my brain starts to get really confused. As I said, am not super up to my education around investment outside of the property space itself. And so I'd love to let you guys indulge me in that information. What does it mean? And what is, I guess, the safest option? Because there's a lot of Aussies here who are sitting there and, the parents have told them for years, right? And people like me on the weekend, on a Saturday at an open house, say, you rarely lose on property, which there has been so much truth to that in the last, couple of decades. But for those who are not risk takers and are thinking, okay, I want to get into this investing thing, and those stats, that $100 a week, that 13.2% average annual return strikes my fancy. What is the safest and easiest option for young Aussies to do that?
I think firstly, it's worth pointing out that you definitely can lose money in property. And I hate the fact that so many people think it's like you get in and you're in. Like, I understand in pockets of capital cities and whatnot, but you can go even buying wrong in cities, you can lose a lot of money. So
certainly,
people need to be shouting that a little bit more from the rooftops.
and let me jump in there too. And I'll say, as a real estate agent, I think, you see it a lot, and we've seen it a lot the last couple of years. If you're not buying quality product and built by the right people, held to certain standards,
Mm.
you certainly can, and you can buy yourself a lot of headaches in the process of not buying smart too.
Mm.
And I'd like to say, hope my bosses aren't listening to this, but I would like to say, as a young Aussie who's meeting young Australians and couples every weekend who are looking to buy, I'm always saying, should really think about whether this is the right thing for you, because it's a big commitment.
Mm.
And I don't think it has to be everyone's future.
Mm.
Like I rent at the moment, and our life is fantastic in our rental. We do not have to worry about anything that goes wrong with the property because our landlord sorts it. Right now, we're paying less to be where we are than we'd be paying for a mortgage anywhere else in the area. And for us, it's certainly the right thing to be doing at the moment. And I don't like the idea of having to move at the end of the year, because there's a lot of junk that's going to come to the surface when it's time to move out of this place. But I am certainly hearing what you boys are saying, and I'm keen to let you dive into this idea around investing smartly and safely, because I think for a lot of young Aussies, until you've found the home that you want to spend your life in, or build a family, and then it feels like the right option, or you found a really smart property to pursue, I don't think it has to be the be all and end all. So,
The second thing that I just want to touch on before we get into the how is that a lot of the stories you hear from your mums and dads saying the stock market is risky, you can lose a lot of money, I think comes from people who have more than likely taken stock tips from mates, or have actually not really had too much input into their own portfolios and have probably been stock picking. And the good news is the way that we encourage people to build wealth, and the way that Ren and I actually build wealth in the stock market, is an overwhelming majority of our portfolio is not stock picking. It is just putting money across hundreds of different stocks in one go, and we can get into that. But the myth that the market is risky and that it crashes and that you lose out, yes, that is true, just like property goes through fluctuations. But I think the stat is something like for every 10 years, I think it's 5, but
Bryce brought this up on a podcast recently, and I tried to fact check him on the fly and couldn't find it. But let him say it with that asterisk in mind.
I'll just say 5. Let's say 10. There is no 10-year period on the ASX or the S&P 500, which is the market over in the US, where if you had been invested at the start of that 10 years and held through to the end of the 10, there is no 10-year period where you would have lost money. Sure, along the way, there is crashes, there's drawdowns, there's highs and lows, but the point is staying through that period. There is not a 10-year period, asterisk, maybe 20 or 5, but I'm pretty sure it's 10, where you would have lost money. So when it comes to thinking about risk in the stock market, and everyone listening to this show, if you're in your late 20s, early 30s, like we are in an absolute prime position right now to take advantage of long-term time horizons here and take advantage of that statistic, getting in the market and building wealth over decades.
All right, so let's get into the actual how. There's these products called index funds, and if you know nothing about investing, it's probably the important place to start. They were introduced by a company called Vanguard in the 1970s, so they're like pretty new in the whole investing world. And essentially, the guy that started Vanguard, Jack Bogle, what he said was that rather than trying to pick individual stocks, if I just bought every single stock that was listed on the market in proportion to their size, so I bought more of the bigger stocks and less of the smaller stocks, I would just get the average return of the market, the average return of how every individual stock has gone over whatever period of time. And his thesis was that doing that and rebalancing that fund every quarter, so as stocks get bigger and smaller, some go up, some go down, he would then resize his positions every 3 months, every quarter. And his thesis was just doing that, buying everything, not making an investment decision about what was good or what was bad. That was the best way to invest. And that was the thesis. And he created Vanguard and created these funds to test that thesis. And it has absolutely changed investing. Vanguard now manages about $10 trillion. It's one of the largest asset managers in the world. And his original thesis was proved absolutely right. So S&P Global is this company that records a lot of data, stock market data. They have a scorecard and they measure how active managers have performed against these indexes. In Australia, over the past 15 years, 85% of active stock pickers haven't been able to beat the ASX 200, the Australian stock market index. In America, over the past 15 years, 88% of American stock pickers haven't been able to beat the S&P 500, which is the American version of the index. So like the starting point is forget what you think about investing rather than buying and trying to pick individual stocks, watch charts, time the market, buy low, sell high, all of that stuff that we hear about investing. Forget all of that. A perfectly valid way to invest, in fact, a very effective way to invest is just buy everything and just let the overall market do its thing as new companies come on the market, new innovations and technologies take hold, new ways of business take hold, and the overall economy gets more productive. The way that we can benefit from that is just owning everything on the stock market. Now, the great news is owning everything on the stock market doesn't mean you have to go and make thousands of trades, because there are products that are listed on the stock market where you can buy everything in one trade. And that's the index fund, or you'll see them as index ETFs. And essentially, that's if you want to stop your investing there and just buy an index ETF for the rest of your life, like Jack Bogle suggested back in the 1970s, that's all you need to do.
Wow, that is certainly simpler and sounds far safer than backing Dad's picks at Randwick this weekend.
Yeah.
And because that has not proved me well in the past. But I will say that the question for you is you spoke about this gentleman who created this coming back and I guess overviewing that every 3 months. How often would you advise for, the everyday individual who's buying one of these index funds to come back and review how that's working for them? Or is it almost set and forget?
Yeah. So the great news is the structure of the fund is they do the review for you. So you as the investor don't have to do anything. You just buy that one index ETF, and then Vanguard or Beta Shares, there's a whole bunch of companies these days that do the same thing. They'll rebalance the fund for you. So, recently in Australia, Commonwealth Bank got bigger than BHP. And so next quarterly update, they'll rebalance the funds so there's more Commonwealth Bank and a little bit less of BHP. But you as an investor don't have to do anything.
Boys, that sounds like a get-rich-easy scheme, and I like it. I've got to say I like it.
Yeah.
I would caution it's more a get-rich-slow scheme, because what you're not going to find with these products is overnight riches, overnight success. And a lot of people come into these thinking, I'm going to invest and I'm going to get a house deposit in 2 years and use that for my house deposit. But that's just not going to happen. The structure of these products, as Ren said, is so diversified across not only different companies, but different countries, different asset classes. You're not going to double your money overnight. But what you will do is more than double your money over 10 or 20 years. One of our most spoken about, I guess, products or ETFs is using Vanguard as an example, is the Vanguard High Growth Diversified Fund, and Vanguard Diversified High Growth. Yeah. And it has Australian, international, emerging markets, small companies. It returned, I think, about 13% in the last 12 months. So in line with what Ren was saying earlier, 13% year on year for the last 100 years. And if you let that compound year on year on year, you're going to be more than wealthy enough. But we just do caution people coming in here thinking that it's going to be the next Afterpay or some crypto where you're going to be doubling your money and walking away rich overnight.
Of course. And, is there any case study to show what investing $100 a week for the next 10 years on that percentage yield would amount to?
So we have a challenge here at Equity Mates called the $100 Challenge. It's not a weekly challenge. While Ren runs the numbers on the weekly, investing $100 a month for 30 years at just in one of these products that we've spoken about gets you about 350K or thereabouts. Now, it doesn't, that's not going to buy you the house or anything like that, but you can see that even if you double that to 200 a month or 250, and as you get older and income grows and you can start putting more away, it starts compounding incredibly quickly. And all you need to do is spend a year or two doing this and just understand and feel and see how the market works, and it becomes pretty powerful.
So I just ran the numbers. $100 a week for 10 years at 13.2%. You will have invested $52,000, and you'll have about $107,000. So you'll about double your money.
But show them what it does if you go 20 years.
Well, yeah. There's a Money Smart. There's a government website, Money Smart, that has a compound interest calculator where you can put all of your different scenarios in here and figure out what it looks like. But I think the important thing to stress is, we're talking about these numbers, 13% as the average over 122 years, but it's not a consistent 13%. Some years you'll get 30 or 35% returns. Other years you'll go backwards, and that sucks. And a lot of people decide investing's too hard and sell their investments at the worst possible time. So there is risk in the sense that it's volatile. It goes up and down, and you've got to stay the course. But the biggest learning that we've had over doing Equity Mates is just, as you expand your time horizon, as you think in decades, not in years, the market becomes far more predictable and far more consistent than you would expect based on how we talk about the stock market in like popular culture and stuff like that.
You know what I love about this, guys? I love that this feels achievable for everyone. Like you said, you can scale your investment and scale your, whether it be weekly, monthly, whatever you want to invest into the market. And I'm big on life by design. Like as a individual, in your partnerships, in your family, sitting down and going, what do we want our life to look like? And how do we make that happen? How do we achieve that? So like, what do we value, and how do we start to rig our life to look that way? And I love that as part of that, part of life by design is thinking about today, but also planning for tomorrow. And the fact that you can do this at any level and still enjoy the present moment and still plan to have holidays and make memories and do things with the people that you love, whilst knowing that the future is feeling a little bit safer and more secure by the decade, I think is a brilliant way for young Aussies to be thinking and approaching this. And I think as you guys continue to educate people, it's why this is typically not the kind of conversation I would have on the podcast. But as a 28-year-old man who's starting to think about those things and seeing, the stress and the conversations I have with mates and the people I have it with at work every day, I'm like, this is a really important conversation to have.
I think as well, like, yeah, we're big proponents of just doing something. Like if it's putting more into your super fund or even just paying attention to your super fund, like let's not forget that almost everyone listening to this podcast, I imagine, is getting their employer to pay them 11% of their salary into a super fund. Now, if you're not paying attention to that super fund and you don't know where that money's going, then that's probably where you really want to be starting, because that's going to be a massive nest egg outside of your family home when you come to retirement. And if you're not putting the right steps in place now and getting the foundation of your super fund sorted now, then you're wasting the opportunity of compound over the next 20 or 30 years. So I think if people feel like they can't do anything, at least look at your super fund. Second point is, if you feel like you can't buy the property and you're feeling priced out and whatnot, but you feel like you could be putting $100 or $200 away a week, then as we've said, there are ways and platforms now where you can do that cheaply. When Ren and I started, it was almost $20 a trade in brokerage costs. Now that's prohibitive and it's expensive, but now you can literally start with a matter of cents and get started investing in the market and dip your toe in without needing to put in $500 or $1,000 to get started. So we just encourage people to just do something, and you'll get that sort of psychological boost of, I feel like I'm doing something with my hard-earned money here. And then from there, the world opens up because you understand that it's not as stressful as you thought it was. It's not as risky as you thought it was. And yeah, you'll be a millionaire overnight. Not overnight, over decades.
Over about 40 years of
over
nights.
40 years, yeah.
When you break it down that way, it doesn't seem like that many, does it?
Yeah.
Hey, so tell me, sorry, go on, Ren.
Oh, I was just going to say, like, just momentum is real in life. And, you know, we all, I reckon, feel it in our personal lives or in our working lives in different ways. Like when you get on a roll and you're kicking goals and things start feeling a little bit easier, or you're starting to feel on top of, you know, whatever it is, where you're building some momentum. It's so true in your personal finances as well. Like whatever that long-term goal is, like just taking some of those steps, whether it's like knocking over some debt, increasing your savings rate from your paycheck, even if it's putting $1 or $2 in the market, like momentum is real. You'll start to feel more confident. You'll start to feel like you'll get it. The next step will be easier. So like if people leave this conversation with one thing, it's just get started, do something.
Yeah, I love it. I think that's a great first rule, great first step. So why did you boys start this? Like where does the connection come between you guys? And what was the first, because every young guy in Australia is lying if they haven't said to one of their mates, let's start a podcast.
Yeah.
But as we spoke about stats off camera, I guess between the three of us, we can say we're part of the 1% who lasted more than 10 episodes. So like, where did this all begin for you boys?
Our friendship began back in 2011. So what are we now? 13 years ago. Jeez, over a decade. 2011, we both were in Canberra at ANU at university and went to college together, partied together, played footy together, did everything. We weren't podcasting at the time, but we ended up living together later in our sort of university journey. I think probably fourth or fifth year or thereabouts. And that's where it kind of started. We started thinking about, as you said, not just podcast business ideas, but many business ideas.
So many.
Classic case of university kids with nothing to do. We thought about creating a soup business to sell to kids at the library at university in the depths of Canberra winter. We thought about importing vintage European clothing, selling that to uni kids. We tried to create an app.
Oh, I'm still bullish on this app idea. Yeah.
It was like a tutor, sort of a marketplace for people who wanted to learn a skill, and then people with that skill to kind of meet and then I guess you'd say it's the Uber of. Yeah,
like you want to learn to surf, you want to learn an instrument, those kind of like skills that don't have formal structures that, you kind of get the tutor by walking down to the surf and seeing if there's someone there, or pulling the tab off the bulletin board at the local library or whatever. Anyway,
it's basically the Tinder for specialty skills.
Yes, yeah. And so we actually went pretty, well, not deep, but like we went to some app developers and whatnot. And then we got to the point where it was, do we put money into that, or do we put money into going to Central America with the boys? And we obviously chose Central America.
We did apply to Shark Tank though.
We applied to Shark Tank. Yeah.
Thank God we didn't get on, because it wouldn't have gone well.
No. So we went to Central America at the end of university, and then both of us got grad jobs. I got a grad job at Woolworths. Ren got a grad job at Coles down in Melbourne. And at that point, we still hadn't started anything, but we'd both been investing in different ways. Ren had kind of started investing in the later half of university, and I'd been investing for a while. And so we kind of then started sharing that interest together. And we were listening to a lot of content that was American focused and at a much higher level than sort of the beginner Australian investor. And I don't know, we just thought that there was probably room for us to track our journey. And And that's where it really started.
I pitched doing a blog, and Bryce said, no one reads blogs, so why don't we do a podcast? Thank God he said that, because I don't know where we would be if we were still tapping out a blog twice a week. But yeah, we just started podcasting. God, we sucked to begin with as well.
Yeah, and it was with absolutely no intention. I think it's very similar to you, like no intention to make money from it. We never intended it to be a business beyond. It was purely so we could go and learn more about investing. And we didn't know anything about it at the time. We kind of knew that there was this thing called value investing and Warren Buffett was roaming around and whatnot. But we used it as a way to go and speak to CEOs, to go and speak to fund managers, to just become better ourselves. So it was a bit of a scratch your own itch, and subsequently grew an audience of people who related, and the rest is history.
Our first tagline was for everybody by nobodies. And I think looking back, we didn't have like a strategic plan at the beginning, but looking back, us just being like, we have no idea what we're doing and we're going to figure it out, and sharing all of our mistakes was so different to a lot of financial media at the time and even today. Like most financial media you see is an expert, an advisor or a fund manager not talking down to you, but like talking to people who know less than them. Whereas we were like, we know nothing and we're here and we're just going to try and figure it out with everyone who comes along. And I think it made us a bit more relatable than a lot of the financial media that was out there. And I think a bit more fun as well. And yeah, we just kept going.
Well, I think it's refreshing as somebody who is, looking to understand investment a little bit better, who's looking to start their journey, when you can actually hear both sides of the coin. You can hear about the wins as well as the losses. You can hear about the journey. You can see the growth in the understanding and the knowledge and the confidence, as you said before, by people who are a couple of years along the journey. Because there's too much of like, you look on Instagram and everyone is certain about everything. And, there's plenty of life coaches that have never made a mistake in their life. There's plenty of financial experts that are telling you if you're not making $1 million a year, what the fuck are you doing? And it feels for so many people so out of reach and so far outside of their world that it can sometimes feel like, why would it even be worth me starting? It's not even worth me listening or understanding this or trying to develop knowledge in it, because that will never be me. And while some people can say that's a limiting belief, the reality is that most people will never earn $1 million in their life, but people can live certainly fulfilling lives on different incomes, with different jobs, with different dreams and goals, by making decisions that are right for them. And I think that's what this is completely about, is understanding yourself and making the most out of the opportunity that you have with your life.
I think the idea that you need to make, $1 million a year or $300,000 a year or whatever it is to build economic security is kind of getting it backwards. I think that the biggest determinant that for your future economic security isn't how much you earn, but it's how much you save. And there's this book that came out in the late 90s. It's called The Millionaire Next Door. It's an American book, but all the principles apply here in Australia. And they surveyed a heap of people, low-income earners, high-income earners, everyone in between. And what they really found, and really the point of the book, is that the people that become millionaires, you can't figure that out based on how much they're earning. The biggest determinant of who becomes a millionaire is how much they're saving. And so like the hallmarks of a millionaire are not the shit you see on social media of flashy cars and, watches and hustle culture. It's people who, drive the secondhand car and, are on top of their money and know where it's going, and, just as saving consistently and then putting that money to work. And so whatever income you're earning, however you're feeling about your money, and, if you're looking on social media, don't try and compare yourself to people on social media, because it's just a recipe for misery. But it's like the thing that will actually make the difference in time isn't what you get paid, but it's what you save. And that's to an extent within all of our power to increase our savings rate. Obviously, cost of living and inflation and the cost of housing has made that harder recently. And like our generation, you know, it's never been hard to be in your 20s or your early 30s. Never been harder to be in your 20s or your early 30s. But the little things that we do to increase our savings rate are going to be the biggest determinants of our future economic security.
Yeah, I completely agree with that, lads. And I think it's important to recognise that everyone has an opportunity to live a really good life. And I think you just spoke to that point there that, you know, I hate that bullshit on social media telling people that, you know, you've got to work this kind of job or you've got to make this kind of money. I think certainly there is something to be said for, I think the key to any success is always consistency. People who are consistent for long periods of time tend to be more successful. And the key to consistency, certainly discipline. And let me tell you, discipline is way easier when you're doing things that you love and you're enjoying yourself along the way. And I'm a huge believer in that. So I think the fact that you guys make this interesting, you've made this for me an incredibly fun conversation to have around finances, which is typically not my forte, as I said. But I want to make sure that everyone listening can come across and find you guys. So talk to me about quickly before I let you go, because I know you got another recording. What is the best way for people to get started on the Equity Mates content?
So the best way to get started, we've obviously got the website, equitymates.com. However, the way we've set up the podcasts is I guess I'll start that again. The way we've set up our podcasts is sort of for two different types of people. If you really want the basics and want to just get confident about getting started, we have a podcast called Get Started Investing. There's also a book that goes with it. We also have a second book called Don't Stress, Just Invest, which is 4 simple steps to set up a portfolio and then to get on with the rest of your life. So those sort of 2 books and then the podcast are a great way to get started. And then, of course, Equity Mates Investing Podcast is where Ren and I show up 2 or 3 times a week and just chat about our journey, what's going on in markets, stocks that are interesting us. We get experts on, we get financial advisors on, and really just continue exploring what's possible in the world of investing. So those are the 2 main podcasts. It's all on the website. And you can follow us on socials as well. We're everywhere.
Look at the upsell on them. They got the books. They got. I love it. I love it. I love it.
Yeah, I mean that's what you got to do these days. You got to be bloody everywhere. YouTube, Threads, we're even there. Wherever you are, we'll try and be.
There's almost too many to keep up with.
Let me tell you,
it's
you just
wild.
got to choose your lane and
Let me tell you.
go.
Do you guys have a team, or is it just the 2 of you?
We have a team. Yeah,
we got a few in the team. As a podcaster, Brad, I'm sure you know there's nothing worse than listening to the sound of your own voice. So as soon as we started making a bit of money, we got an editor to edit the audio. And a few other people over the journey.
Oh, that's great. I love it, guys. You guys deserve all the success in the world, and so grateful that we got the opportunity to have a yarn. Probably should have come up there to the studio, but maybe next time. When we do a catch up, and I'll let you know about my progress and the advice that I've taken from you guys, and hopefully off the back of a bit of a bull year in the market, and I'll be extra excited.
Yeah. Now, well, look, we appreciate you coming on, and I think what you're doing is really important as well, having some of these conversations. So thanks for giving us your time.
My pleasure, guys.
Thanks,
all the best.
Brad.